This is Alphabet's balance sheet for the last 5 years. Now let's focus on the intangibles part, especially those two shaded rows that you see on the screen here. What's perplexing is that while the company's revenue, operating income, and net profits have gone up by 23%, 32%, and 57% respectively, the intangibles and particularly the other intangible assets line item has actually gone down by 15%. So the real question is, what are these intangibles that seem to have a diminishing value in Alphabet's balance sheet? Well, for starters, these include some 30,000 patents which the company has just in the United States. It's the in-house technology that the company uses for its search algorithm that powers Google.com and YouTube, the trade names that are owned by the company, and it's the know-how of AdSense, Google Maps, AdWords, Gmail, Android, Google Docs, etc. And all of this is being valued on Alphabet's balance sheet at a mere $1.4 billion. I'm sure you can see where I'm going with this, because it's these $1.4 billion worth of intangibles that has been really powering Alphabet's growth, sales, and profits over the years, and has been mostly responsible for the company's growing market capitalization, which went up from $730 billion in 2017 to $2 trillion in December of 2021. And so in this video, we shall pan our focus on this often less discussed area called intangibles as we detail out the accounting of intangibles, its growing stature in balance sheets, how intangibles are deeply linked to company or sector growth, and of course, its importance in investing. Let's begin. A lot like what we saw in the case of Alphabet, the accounting of intangibles is a complete mess. Let's say we have a subscription business, and actually ET Money has a subscription business and a pretty good one with our Genius offering. So let's build a case around that. Now we charge a sum of 3,000 rupees for an year's subscription to Genius. And let's assume it costs our marketing team about 5,000 rupees to acquire a Genius subscriber. So on the face of it, this transaction is not a profitable one, at least from an accounting point of view. But what if I told you that this Genius user is expected to stay with us for the next 10 years, which will consequently give us 30,000 rupees in revenue, which means what our accounting knowledge tags as a loss, the very same transaction becomes a highly profitable one from an economic point of view. This concept is popularly known as lifetime value, and while you don't find it in financial statements and in your P ratio, PB ratios, the factor has a lot of applicability in telecom companies like Airtel and Jio, video streaming companies like Hotstar, Netflix, newspapers and content publications, Amazon Prime, edutech companies, etc. A lot like marketing, research and development activities too face the same accounting problem. For instance, in the case of ET Money Genius, we have this amazing algorithm which helps investors beat the benchmark on a consistent basis. This algorithm is, of course, our proprietary tool, meaning it can't be duplicated by anyone, and it's pretty long lasting, which means Genius will continue to churn out results for us day in and day out for years to come. So essentially, we have this asset that's probably worth millions of dollars, but accounting wise, this asset would not even exist on our balance sheet and would merely show up as an expense in our income statements. But having said this, if you are a savvy investor who understands this inconsistency, then there is a lot of money for you to make. The first way of using this to your advantage is by recognizing the mismatch in reported current earnings and unreported future earnings on account of these intangibles. One company that comes to mind in this context is Amazon, which showed depressed earnings for over a decade while plowing back their cash flows into the business to grow it even further. A second way to exploit this issue is in the lines of what we discussed with Alphabet and ET Money Genius. That is, the balance sheet assigns a zero asset value for internally financed capabilities like product research, brand building, and software development. Your job as an investor will be to recognize this gap and then apply a valuation technique on it, which we'll discuss in later sections of this video. The assessment of intangibles remains one of the most ignored parts in valuation, especially with investors who prefer to analyze companies using traditional metrics like the price to book value or the price earning ratio. Truth be told, metrics like the PB ratio work particularly well with old economy companies like energy, manufacturing, consumer durables, cement, etc. But as companies become more service and technology oriented, these same metrics seem to be losing their predictive power in equity value creation. In the same context, the P ratio looks artificially high in case of companies with digital investments, which might look like a rash assessment a few years down the line. These inaccuracies happen when investors take these accounting figures at face value, which almost always leads to incorrect valuations. The point is, your PB ratio and P ratio should no longer instinctively be considered a North Star for attractive investments, especially in evaluating companies that are bound to have intangibles. I, for one, started out as a price to book and price to earnings guy, but with experience have come to realize the importance of intangibles. And it's not just me, even the great Benjamin Graham wrote in his book Security Analysis, and I quote, "It may be pointed out that under modern conditions, the so-called intangibles, for example, goodwill, or even a highly efficient organization are every whit as real from a dollars and cents standpoint as are buildings and machinery. Earnings based on these intangibles may be even less vulnerable to competition than those which required only a cash investment in productive facilities." Over the last 4 decades, the share of intangible assets has seen rapid growth. Case in point is the S&P 500, whose market value now comprises an 84% share from intangible assets, which was barely 17% in 1975. Additionally, capital expenditure is nowadays directed more towards virtual rather than physical resources, with every industry, including fitness, arts, education, and retail, which were traditionally physical cutouts, having a digital arm. Strangely enough, very few investors have incorporated this shift within their investing framework. And so let's have an overview of some intangible specific valuation models that may be of assistance here. The first valuation technique is the relief from royalty method. As the name suggests, this approach calculates the value of intangibles on the basis of hypothetical royalty payments that would have been saved by owning the asset rather than licensing it. For example, ET Money has its own algorithm for Genius, but we don't have a valuation for that. So if we were to apply the RRM technique, here's what we'll have to do. Step 1, we will determine the annual cost of licensing or outsourcing the algorithm, and let's assume that comes to 100 crores per year. And step 2, we'll run a discounted cash flow analysis on it. Now I'm opting for a simple 5-year DCF with no terminal value, and I'm using a discount of 12%. This gives us a hypothetical valuation of $48 million for our algorithm, which is at least a starting point in the examination and evaluation of the company's truest assets. Of course, as we have seen here, there are many assumptions to this RRM approach, but if done right, it can be used to value a number of intangibles like domain names, trademarks, software, in-progress R&D, etc. Basically anything to which a specific revenue stream can be attached. A second approach that can be used to value intangibles is the with and without method. What this approach essentially says is that an intangible asset's value is nothing but the difference of two discounted cash flow models. One that represents the business's status quo with the intangible asset in place, minus scenario 2, which represents the business worth without that intangible asset. And while on the face of it, this approach sounds a bit unscientific, at least to me, this method is utilized in many places, especially in the creation of non-compete agreements. And the third valuation technique that one can explore is the replacement cost method. This approach is a bit like reverse engineering, meaning we are looking to arrive at a present day cost of constructing an intangible asset using materials, machines, and talents at today's prices. For example, say your company has developed a software using internal resources for the last 3 years. So to arrive at the value of the software, all we need is the number of man hours it took to make the software and to multiply it with the current average hourly remuneration of the development team. This multiplication gives us an estimate of how much it would cost to create a similar software, and that's the replacement cost method. But having said this, do note that this approach cannot be used for other intangibles like patents or copyrights, which are income generating and therefore would be more suited to the relief from royalty or the with without method of valuation. Of course, as you must have figured by now, valuing intangibles is an inexact science, but it's still better than trying to value companies like Google with valuation metrics like PB or the PE ratio, which is likely to be a waste of time. So here's a story I like. In the last 25 years, Coca-Cola has invested about $67 billion in building its brand, which is today a key competitive asset for the company. The value of the Coke brand is best illustrated by that famous Pepsi Challenge campaign, where Pepsi showed that in a blind taste test, subjects preferred Pepsi over Coke. However, subsequent studies found that when the bottles were labeled with Coca-Cola and Pepsi respectively, the subjects preferred Coke to Pepsi, and since then this phenomena has been termed as the Pepsi paradox. You see, what was happening is that the subject's brain was responding positively to Coke's brand association, which is another way of saying that Coca-Cola does not owe its market leadership to its secret formula, but it owes it more to the dominant, likable brand that it has created. Of course, quantifying the so-called brand equity is not easy, but if we keep the mathematics aside, I'm sure we can all agree to the point that companies that master the deployment of intangible investments are better positioned to outperform the market as compared to their peers. It's a lesson that can be substantiated with one glance of the world's top companies, which have mostly been built on intangible assets. I like to end this video with something I read in a Twitter post which goes something like this. Early in the 21st century, a quiet revolution occurred. For the first time, the major developed economies began to invest more in intangible assets like design, branding, R&D, or software than in tangible assets like machinery, buildings, and computers. For all sorts of businesses, from tech firms and pharma companies to coffee shops and gyms, the ability to deploy assets that one can neither see nor touch is increasingly the main source of long-term success. And if you too are looking for long-term success in investing, then do check out ET Money Genius. Do subscribe to this YouTube channel, do like this video, share this video, and I look forward to catching up with you next week on another insightful topic. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.